As Sebastian mentioned, open up, we've been crowdsourcing a number of questions for a very esteemed panel here over the next hour. And I'm very excited about this first speaker. Joining me to have a conversation to answer some of your questions is Nancy Lazare. Nancy is a true economist, the CEO, the founder for Cornerstone Macro, who also co-founded and was the vice chairman of ISI Group for over 20 years, and is going to provide us with an excellent overview and an economic take. So thank you very much for joining us, Nancy.
Thank you.
So I want to jump right in. We'll get right to it, right to the heart. We've heard a lot of talk about rate cuts. It seems to be in the news, in popular media, and yet, when you interpret that talk about the rate cuts, do you see a slowdown for the second half of the year?
Not at all. So this economy, this expansion has been pretty volatile. It's now going into our 11th year. This is the third slowdown we've had. I think the slowdown is actually over. But we've had 3 of these in the past, so this is now the fourth slowdown. After each of those slowdowns, the economy's reaccelerated. Why? Well, they classically have been the pause that refreshes, interest rates come down, you have easy enough financial conditions, and because the economy is healthy, which we'll get into a little bit later, the economy can indeed reaccelerate. So I think the Fed's behind the curve. They were behind the curve in 2016, and I think they're behind the curve again today, that the economy, we would argue, is actually accelerating as we go into the back half of the year in both the United States and China, creating a stronger global backdrop.
So with that strengthening economy then as a backdrop, both here in the U.S., and you mentioned China specifically, then how does that play into where you see capital spending going? And is that part of that acceleration?
So not only is this the longest expansion on record, we are now actually seeing the longest capital spending cycle on record, which is totally contrary to what you read in the popular press, maybe except for Bloomberg. But capital spending, again, has been volatile, this expansion, but net, it's grown for 10 years. And this has been, again, the longest capital spending cycle we've had. And it's actually a broad capital spending cycle. It's not just the energy space. It's not just Amazon. It's from tech companies to manufacturing companies to the oil industry to infrastructure, even infrastructure spending in this country. And so for some reason, I'm not sure why, there's been a negative spin on U.S. capital spending. Yes, stock buybacks have increased more than CapEx, but you've also had a very positive capital spending cycle. So as we move into the back half of the year, you've had a 100 basis point decline in corporate bond yields. Domestic corporate profits are quite healthy. There is a shift of production back to the United States, which we've been talking about since 2010. This is not just related to the trade war or the shifting of the supply chain. So yes, capital spending will be a part, has been solid this expansion, and will accelerate in the back half of the year.
You mentioned that the expansion was not just limited to the U.S., even though you mentioned coming back to the U.S. is certainly a part of it. So with that expansion in China and elsewhere, you believe that even as the resources ship back to the United States.
Yeah. So you read a lot that globalization is dead. Well, what exactly does that mean? Well, from my perspective, it meant everything, all the capital spending was done in China in the 2000 through 2000 and really 10, 11, 12. And now that capital spending is being dispersed around the world, from Vietnam to Japan, even back into the United States. And so we've called this the U.S. manufacturing renaissance. So even though you are getting a pickup in China, it's very different pickup in China. We're calling it Goldilocks pickup in China. It's going to be a more moderate pickup, not led by investment, led more by the consumer in China.
So with those pickups, that actually segues nicely into our next question. Certainly to have these acceleration, to have these pickups, productivity has to be playing a role in that. So what else do you think is really driving productivity as part of that expansion?
Yeah, well, technology is a huge part. Within capital spending, the driver, and I meant to say this, within capital spending, the driver has been technology. Technology includes software and hardware. A lot of companies don't include software in their capital spending budgets. As an economist, I do. Software CapEx has been growing double digit. That's been a major support of the capital spending cycle and has made it easier for many companies in turn to improve their productivity.
In terms of that, it's an interesting point you just make about software versus hardware, especially as more things go to software. Do you think that's one of the reasons why productivity numbers are sometimes perhaps lower than what you're talking about?
So productivity, there are really the haves and the have-nots within the productivity. The data are showing a very clear pickup in productivity. Again, the popular press just doesn't, for whatever reason, or the Fed has decided not to really emphasize the improvement acceleration we've seen in productivity now for about almost 3 years. So productivity has picked up, but within the economy is very bifurcated. You have the haves and the have-nots. The Amazons of the world, obviously the e-commerce space. Productivity for e-commerce companies is 6%. Productivity for e-commerce companies is 6%, which is off the charts in my world for productivity. Classically, 2 to 3% is strong.
Sure.
If you're a non-e-commerce company, retailer, your productivity is 0. So I think part of the problem in appreciating the strength in productivity, you really do have these haves and have-nots. Slowly but surely, those that aren't reinvesting in their business, aren't improving their productivity, quite frankly, going to die. I give you Sears, which is an example I use all the time.
It's interesting, again, this is a nice segue in terms of the have and have-nots, because one of the parts of the have and have-nots that we hear about, certainly that we do hear about in the media, in the press, has to do with automation and robotics, a topic that we'll be covering more throughout today. And so it seems to be, while we think of robotics and automation as productivity increases, the media likes to spin that in terms of fear and jobs. Effectively jobs. And so what are your predictions for the job replacement in the US market or even in globally with that automation?
Yeah, automation is not new in this country, thank goodness. It's what's driven this country for decades, from the automotive age, where we shifted from horse and buggies to cars. Imagine the protests that existed, that did, in the earlier 1900s, where the horse and buggy trade died and the automotive age boomed. And so this has been going on for decades. We were talking earlier about cell phones, and I remember having operators, ladies in the back office answering telephones. Has anyone ever questioned what happened to all those women? So automation is not new. It's when you invest, it's when you improve your productivity, you actually improve your profitability and can hire more people. If you haven't read Ken Langone's book, I Love Capitalism, it says it best. So if you don't reinvest in your business, indeed you can't hire anybody. I hate to pick on them, I give you Sears. They've not kept up with the e-commerce space, and obviously, but Sears is not the only example. There are many in the retail space, and therefore they can't hire. So retail employment is declining while you're seeing e-commerce hiring actually increase. Decades, not a new story.
That seems to coincide with what you're talking about with software, with the reinvestment effectively is what's driving these have or have-nots, both in terms of automation then leading to continued job sustainability, but also then productivity on the upside.
And what's exciting about software and the cloud in particular is that it's making an improvement in productivity easier for the smaller and medium-sized businesses and not just the larger companies. It's making it more affordable. And so you're seeing software embraced by a broader footprint of companies in the country, which is making it easier for productivity indeed to go up.
It's interesting that we're having these conversations about automation taking jobs, especially in a backdrop where unemployment is at almost historical lows in many, almost across the board. And so with that scarcity of labor, so you have Americans effectively living more off capital, and certainly the government, really than most comparables in history. How are U.S. companies then? Is it back to reinvestment and software and to find growth and competitiveness? Or how do U.S. companies continue to stay competitive in that environment?
Well, it's both. First, there isn't really a shortage of labor yet. There will be at some point. But what's not focused enough about is that the lack of investment in this country in the decade from 2000 to 2012 actually destroyed jobs in this country, destroyed the breadth of jobs in this country. People left the job market, and in turn, you had this surge in the number of people on disability. And so in my world, something called the prime age labor force participation rate deteriorated in an unprecedented fashion for about 15 years. It's now just started to recover. We're finally luring people. You're getting companies are retraining. Yes, automation is is improving profitability, is giving companies the ability to continue to hire people, and they're retraining people from ex-cons, peoples with not proper educations. It's very exciting. The New York Times wrote about this on July 1st, 2019. I know that date because it was stunning that it was on the front page of the New York Times. This is the healthiest job market I've seen. Careful in reading the popular press and make sure you know the facts. And this is one of the strongest job markets we've had. And it's happening because companies can improve their productivity, elongating the cycle, and hire more people.
Has that labor participation rate and the decline that it took and effectively that low starting point, has that helped to accelerate automation, or does that play alongside technology, a combination? How do you think that participation rate has encouraged automation?
Well, when it declined as dramatically as it did, indeed, their companies had to do more internal investment to improve their productivity. But now it's coming back the other way in that health of U.S. companies today, and I'm emphasizing domestic companies much
Sure.
more than I would be international, those focused on China, gives them the ability to train people to learn these new skills to also be a part of that automation. So I just really want to make it clear, automation does not destroy jobs. Automation actually keeps an economy healthy and creates jobs. History shows that, and we're seeing it today. And the fact that we have such still a pool of labor to come back into the labor force, we're not done tapping those people, means that you keep wage inflation lower longer. At the same time, you're getting productivity, which means core inflation stays lower longer, which further extends the cycle.
And as that cycle extends, we'll also see an increased consumer spending. So where do you see consumer spending there for the rest of the year?
Yeah, consumer spending probably is going to slow down a little bit, but a lot of that is just data volatility. Consumer spending was 1% in the first quarter. It's going to be 3 to 4% in the second quarter. It's like, geez, what's trend? Well, trend's about 2.5%. And that's kind of where we see it settling in. But the bigger story on the U.S. consumer, it's the healthiest consumer I've ever seen. We call it the new, smarter consumer. Saving rate is 6%. And so when you do get a temporary shock to the economy, the consumers can dip into their savings and keep the expansion going. So even though there is this incremental slowdown in the consumer, I don't view that as a negative. It's maintaining a platform where the consumer isn't borrowing too much money, depleting their savings, and again can help extend the cycle.
One part of borrowing into their savings leads us into the question really about interest rates. We've been in a low interest rate environment, and yet talk has been back and forth about potentially lowering further. So it seems like the trend is that low interest rates are going to be with us for a while. Certainly globally, that certainly seems to be the case. Do you agree with that here in the United States?
I think you nailed it. It's really a global issue. Interest rates are a global issue. That is, if interest rates in the United States are 2.5 and in Italy 1.5, which is, well, we're not quite 2.5 here. We're still only around 2. But really? And so because the global backdrop, Japan and in Europe are so low, yes, that will keep our interest rates lower longer. I would say that's not a true reflection of the health of the U.S. economy, but the bond markets indeed. And central banks are tied to the world.
So what you're saying is that part of what we're seeing is effectively supply and demand,
Sure.
rather
Sure.
than true reflection of a domestic economy
That's right.
in a global environment.
Whenever you model bond yields, which we do, you have to add a component for what global yields are doing because they, to be sure, are going to have an effect on what happens to our interest rates.
So you said you do see that continuing. Does that imply then that you see internationally those rates continuing to stay lower, thus effectively keeping ours
We were talking
depressed?
I was talking about this with some of my team from Cornerstone earlier, and it's unfortunate that there is a general unrealization that monetary policy can't solve all issues, and therefore the central bank in Europe is going to probably cut rates, maybe even this week, and they're already extremely low. That's not what ails Europe. It's they need their own increasing productivity growth, which you don't have, and as a result, they're going to have a dysfunctional low growth environment, which will, yes, keep interest rates there in particular on the low side.
So certainly when we talk about now international and how these are playing against each other, really the headline story here for quite some time now has been the impact that the U.S. and China relations have had. Certainly the trade war gets a lot of coverage. Gets a lot of tweets and characters. But what do you think the impact of that trade war has really had on both the U.S. economy, just focusing on the U.S., but also global innovation? You just referenced innovation and productivity needs in Europe. Is that a side effect? How's the global response to this been?
So, I hate the trade war is certainly not a healthy path to go down. Trade in general should be free and fair. But at the end of the day, there was too much investment going into one country, China. And what's happening with the trade war is companies are moving the supply chain around the world, from including to smaller countries such as Vietnam. And so I actually view that as positive. Again, globalization isn't dead; it's just matured. It's being dispersed to other parts of the world. That's healthy. That you can now help to boost some of these other smaller countries, but also come back to the United States. And what you're seeing is that investment is coming back, as I mentioned, and part of that is also also innovation. So, if anything, again, I'm not sure I'd ever want this publicized. It's helping to disperse innovation around the world and helping individual countries, and therefore helping the global economy. And China knows this. China knows they can't grow as quickly as they've been. They're well aware of that. They've matured as policymakers, and I'm actually kind of excited about the prospects for a much slower but sustained Chinese expansion. They understand they have too many excesses and they need to be more consumer focused rather than capital spending and export oriented.
You're talking about the dispersion and some of the benefits of where there are clear pockets of winners from that. Is that, other than, say, the U.S. and China, the direct participants, are there then losers from that as well, or is it just focused on the dispersion?
Well, if you're a country that isn't embracing businesses or innovation, then you will be a loser. And I think that is part of the European problem right now, in that they're not, some countries are, France is trying to move in that direction, but some countries aren't embracing that. Korea is not really embracing that right now. And so, yes, there are definite, Russia, definite losers in this game.
So as we've seen that low interest rates, whether it's impacted by a number of the things that we've just talked about, it seems to me, at least from the popular press, maybe not the more in the depth or in the economic research, but talk of the yield curve has certainly gotten a lot more oxygen from people that I'm not sure historically have ever talked about it before, maybe not even necessarily know what they're talking about. So we'd rather have you interpret the yield curve for us.
Yeah.
What implication do you see with the yield curve that we have? It's certainly flattening towards inversion, but what does that mean? How should we really think about that relative to our economy?
Well, yeah, to that last bit, it is a problem for banks, to be sure, but it's not a problem for the United States. The yield curve is a good, but not a perfect recession risk index in the United States. The yield curve, the last time the yield curve flattened the way it has today, with bond yields coming down pretty significantly and a little bit of a Fed tightening cycle, I would say this is most similar to the 1990 period. How many of you remember the 1990s? Okay. It was a period where we had surprisingly slowing inflation and accelerating growth, and the bond market was doing a what? Bond yields were too high, and indeed they came down, while in 1994 the Fed tightened pretty aggressively. But as you went through 95 into 96, Greenspan caught it, recognized that inflation was indeed a lot lower than what certainly was a couple of years ago prior to that anticipated, and indeed he could slow down his tightening cycle, and bond yields kept coming down. So you had a pretty flattening yield curve in the 1990s. Bond yields were coming down because of a lower inflationary environment, an acceleration in productivity at the same time, and was not a sign of a recession, was a sign of a low inflationary environment. And I would argue that's similar to what we're seeing today. U.S. inflation is low, it's going to slow. That's holding bond yields down along with what's going on globally. It is not indicative at all of a U.S. recession.
That kind of ruins the question that we have planned next, because you already beat to the punch. So I'll really ask it more in the phrase of, maybe for our last question, if there's anything else that I should have asked you, but I did not.
Well, just to continue on that theme, which is when will the next recession be, the Fed certainly can slow down the U.S. economy. Obviously, higher interest rates can slow down economic activity. But it's not just higher interest rates that create recessions. It's a combination of higher interest rates and excesses. Classically, inflation is one of those excesses. And today we don't have that. Overinvestment is, again, one of those excesses. Housing was one of the excesses going to last recession. We don't have that today. So that's why, despite the fact that interest rates have gone up and down for 10 years now, we've not had a recession. In part, inflation has stayed low, and the underlying trend in the economy is healthy with limited excesses. We actually model this out. This is not something I'm saying cavalierly or quickly. We spent a lot of time analyzing this. And so the bottom line is, I think the story, not just for the back half of this year, but for 2020, is that an extended cycle with low inflation, which means highest odds of recession may not be until after 2021.
Fantastic. Well, we really appreciate Nancy being here. Please join me in giving Nancy a round of applause.
Thank you.